What if I told you that a married couple in retirement could pull in over $94,000 a year and pay absolutely zero in federal income tax? Not a typo, not a loophole, just the actual tax code working the way it was designed. Most couples have no idea this is possible, and they're paying thousands more in taxes every year because of it. Here's how it works. This isn't some shady tax shelter. This is the standard deduction plus the 0% long-term capital gains bracket working together. Let me walk you through the math, and then I'll show you how to actually pull this off. Here are the two key numbers. The first number is the standard deduction for married couples filing jointly. For 2026, that number is around $30,700. If both spouses are over 65, you get extra. Each spouse over 65 adds an additional $1,600 or so to the deduction. So, a married couple where both spouses are over 65 gets roughly $33,900 in total standard deduction. The second number is the 0% long-term capital gains bracket. For married couples filing jointly, you pay 0% on long-term capital gains as long as your total taxable income stays under about $96,700 in 2026. Stack those two together, and here's what you get. Standard deduction of $33,900 plus the long-term capital gains 0% bracket of about $96,700 equals just over $130,000 of total income that can be tax-free in the right circumstances. But for this video, I want to focus on a simpler version, just the standard deduction plus the 0% capital gains bracket. That gets you to roughly $94,000 of tax-free income for a married couple both over 65. Let me show you how. Here's the trick. Not all retirement income is taxed the same way. There are basically four types of income retirees pull in. Ordinary income. This includes withdrawals from traditional retirement accounts like a 401k or traditional IRA, pensions, and a portion of Social Security. This is taxed at your regular income tax rates. Capital gains. This is the profit from selling investments held in a regular brokerage account for more than a year. Long-term capital gains have their own preferential tax rates, including that 0% bracket I mentioned. Tax-free income. This includes withdrawals from Roth accounts and health savings accounts used for qualified medical expenses. This never shows up on your tax return. Social Security. Up to 85% of your Social Security benefit can be taxable, but it depends on your other income. If your total income is low enough, none of it gets taxed. The strategy is to mix these income sources in a way that keeps you under the relevant tax thresholds. Let me show you how this works with a married couple, both age 68, both retired. They need about $94,000 a year to live comfortably. Here's how they could structure that income to pay zero federal income tax. $40,000 from Social Security, combined for both spouses. That's about $3,300 a month combined, typical for a couple with average earnings histories. $20,000 from a traditional IRA. This is ordinary income, taxed at regular rates. $34,000 from long-term capital gains. This is from selling appreciated investments held in a regular brokerage account. Total income, $94,000. Now here's where the magic happens. First, calculate how much of Social Security is taxable. Because their other income is moderate, only about 85% of their Social Security gets included in taxable income calculations. That's roughly $34,000. Add the $20,000 of IRA withdrawal. That's another $20,000 of ordinary income. So combined ordinary income for tax purposes is about $54,000. Subtract the standard deduction of $33,900. Taxable ordinary income equals about $20,000. That $20,000 falls in the 10% and 12% brackets, which would normally generate about $2,000 in federal tax. But here's the twist. They also have $34,000 in long-term capital gains. Capital gains are taxed at 0% as long as total taxable income stays under that $96,700 threshold. Total taxable income for this couple is about $54,000, well below the threshold. Now here's the part most people miss. The first portion of their ordinary income is also wiped out by the way capital gains stacking works with the brackets. With careful planning, the entire tax bill on this $94,000 of total income can be pushed down to zero or close to zero. The actual mechanics get complicated, and the exact number depends on your state and specific situation. But the principle is real. Married couples in retirement can pull in around $94,000 of total income and pay little to no federal income tax with the right income mix. Here's what you need to make this strategy work. A brokerage account with appreciated investments. You need actual long-term capital gains to take advantage of the 0% bracket. If all your money is in traditional retirement accounts, this strategy doesn't apply to you directly. Some money in Roth accounts or health savings accounts is helpful, but not required. These give you tax-free buckets to pull from if you ever need to. Low to moderate ordinary income. Once your ordinary income climbs too high, you push your capital gains out of the 0% bracket. A willingness to plan your withdrawals deliberately each year. This isn't a set-it-and-forget-it strategy. You need to look at your income mix annually and adjust. Most retirees default to pulling all their income from traditional retirement accounts. That's the simplest path, but it's also the most expensive in taxes. Every dollar pulled from a traditional 401k or traditional IRA is taxed as ordinary income. So if you need $94,000 a year, and you pull all $94,000 from a traditional IRA, you're paying ordinary income rates on the whole thing. That could be $10,000 or more in federal tax, plus state taxes. By mixing income sources, some Social Security, some traditional account withdrawals, some capital gains, maybe some Roth, you can dramatically reduce that tax bill. The reason most retirees default to traditional account withdrawals is simple. That's where most of their savings are. After 40 years of putting money into a 401k, that account is huge. The brokerage account might be smaller. The Roth might be small or non-existent. This is part of why tax planning needs to start years before retirement, not after. The decisions you make in your 50s about how much to put into Roth versus traditional accounts shape your flexibility in your 60s and 70s. People who only have traditional accounts have fewer options when they retire. People who built up multiple types of accounts have many more levers to pull. Here is why this matters even more in your 60s. For couples in their early to mid-60s, before required minimum distributions kick in at 73, you have maximum flexibility. You get to choose where your income comes from each year. This is the window to be strategic. Once required minimum distributions start, you lose some of that flexibility because the IRS forces you to take money out of traditional accounts whether you want to or not. So if you're between 60 and 73, every year is a tax planning opportunity. Use it. Here's what I wish more retirees understood about taxes. The tax code rewards people who plan ahead. It punishes people who default to the easiest path. The difference between a strategic retiree and a non-strategic retiree can be tens of thousands of dollars per year in unnecessary taxes. You don't need to be a tax wizard to take advantage of this. You just need to know that different income sources are taxed differently, and you need to be willing to think about where your money comes from before you pull it. If this opened your eyes, hit that like button and drop a comment below. What's the biggest tax mistake you see retirees making? I read every comment and I love hearing your stories. And if you want more content that helps you keep more of your money in retirement, subscribe. I share exactly what I wish I knew so you can make smarter money moves.